Hi, this is Andrea Kane, and I'm here with you for HIT 452 Statistics and Data Analysis. We are now on week 10. During week 10, we're going to take a look at our textbook chapters 9 and 12. So this will be the first of two video lectures. This one is on chapter 9. The next one will be on chapter 12. We are focusing on unit objectives 9.12.1 through 9.12.4 if you're looking at your syllabus. And if you would like to follow along in your textbook, please flip it open to page 147. We're going to be talking about statistics that are computed within the HIM department itself, about HIM department functions. So our learning objectives, according to the book, are to relate the following terms: FTE, or full-time equivalent employee, budget, fiscal year, variance and variance analysis, payback period. We'll also be explaining the use of various statistics to operations in a HIM department in terms of unit labor cost, productivity, staffing levels, and budgets. We will differentiate between operational and capital budgets, so make sure that we know the difference between those two and what they're used for, and develop the appropriate statistics to use in the management of an HIM department. So let's talk about HIM statistics. They usually relate to, unit labor cost, productivity, and staffing. Your book does a really great job of giving you examples. So again, I'm going to keep referring you back to your book for these. But one of the first things you need to know is, what is the annual compensation for each employee? This is calculated by multiplying the number of hours worked per year, and for a full-time FTE, that would be 2,080 hours, by the hourly wage, and then multiplying that number by the percentage of benefits received. So a good example of this is at the top of page 148 in the second paragraph. It gives you a sample calculation of 2,080 hours times $15 per hour times 30% benefits. And then it calculates all of that out for you to see that a full-time FTE paid at $15 an hour with 30% benefits will cost the organization a total of $40,560 per year. And you can get the benefits percentage from Human Resources. They keep track of that. And it can range. Some places it can range as low as 18%. Other places it can get as high as maybe 38 to 40%. So it just depends. And then this is the formula. And again, they gave you that example there. They also give you some examples for 9.1 and 9.2 on page 148. Now, looking at unit labor cost, this is determined by dividing the total annual compensation by the total annual productivity. The formula for that is listed on your screen. And let's see, what example do they give to us? Again, you can look at 9.1 or 9.2. And you can see how they walked through those. Productivity is a unit of performance defined by management in quantitative standards. It's a ratio to measure how well an organization converts input into output, meaning the cost of a person into what they produce. Most HIM departments have productivity standards for different areas in the department. They give you some examples here that in the coding section, a productivity standard may be that the employee should code 4 inpatient records per hour. Or, for example, in a 7.5-hour workday, taking into account breaks and the 30-minute lunch, that this would be 30 inpatient records per day. Factors that influence this decision include other tasks for the coder, such as abstracting, answering the phone, getting additional information, writing coding queries, all those types of things. It can also include types of records coded. For instance, if you have a long length of stay chart, it's going to take you a lot longer to code a chart where a patient's been in for 5 to 7 days rather than 1 to 2. Difficult clinical cases are another example of where it may take longer. if you have a patient that's in for 2 days, they're in and out, let's say it's a labor delivery case, an OB. Those are very easy to code, very quick to code for the most part. If you get into a complex surgery case where the patient may have ended up in ICU for a couple of days, may have been on a vent, and all those types of things, it takes a lot longer to code because there's more that goes into it. So on average, if you say 4 inpatient records per hour, you need to take into account that average should reflect what if they have an OB case versus what are they if they have a complex case. Otherwise, that 4 inpatient records per hour needs to change based on length of stay or difficulty or things like that. There are two simple formulas that accurately calculate labor productivity. One is completed work, and that's total work output minus defective work. The other is labor productivity, which is completed work divided by hours worked to produce the total work output. Determining the total work output and the hours worked is clear, but determining the defective work involves auditing work to determine if any work is defective, meaning does it need to be done over, is it incorrect, those types of things. There's different ways to audit records. You can perform 100% review of records coded, which if you have a brand new coder and this is the first time they've been coding, you may very well want to do 100% review of their records for the first couple of weeks to make sure that truly nothing's slipping through that's inaccurate, that you're able to give the coder feedback. You may want to audit by looking at a review of records coded through a random sample. Oftentimes we did this for ongoing cases just to make sure that things were going well. So every 50th case that a coder did, you might look at. Every 75th case you might look at. Every 100th case you might look at. So it just depends. You set the random sample and then you pull those records and then look at those. And some systems will let you set this up on a management function so that it actually pushes you those records based on the parameters you put in. And then another example of auditing is to use a fixed percent random sample audit, where you say that we're going to look at 10% of every coder's records, and once we look at that 10%, then we're going to be able to classify how much of it is completed or defective, and we'll use that against their entire against all of their records. So those are the three types. Staffing levels. There are a variety of methods to determine staff. You can look at patient encounters, because every encounter you're going to have to do something with in terms of medical records per full-time equivalent or FTE per month. And then, so you can do that. You can look at dividing the number of patient encounters by the productivity. So that also can give you number of FTEs needed. And I would say that that's probably the most common. That's what I used. You take the different types of records and you break them down, and you would know what your productivity is. For instance, coding, you would know what it is on average for inpatients versus observations versus ambulatory surgeries versus ED versus outpatient ancillaries and those types of things. And then you can also set those productivity standards for scanning, prepping, scanning, QA, and validating that whole process. You can do it for chart analysis. You can, on average, release of information is usually done separately, and it's not necessarily based on patient encounters. It's usually based on historical data, but you can see what I'm saying. You can get that information. Budgets. Budgets are a plan that converts the organization's goals and objectives into targets for revenue and expenditure or spending. The planning of the budget begins several months before the facility's fiscal year begins, and I would say it begins at least 6 months, usually 9 or more months before the next fiscal year. So you're really trying to look into a crystal ball, and oftentimes that crystal ball is fuzzy. I mean, think of the individuals who are budgeting in 2019 for 2020 and had no idea that COVID was going to hit and throw everything off. You're budgeting so far in advance because it has to go through all these steps to get it done and get it approved and get it back into systems and back down to department leaders that you're often guessing almost a year in advance what life is going to be like. So things that just pop up like COVID can be absolutely, they can just absolutely wreck your budget. You make estimates of expenses for the department, including wages and benefits, supplies, travel and education, membership dues, subscriptions, postage, copying, equipment maintenance contracts, and any other expenses you can possibly think of. Estimates are also made of revenue coming into the HIM department. Typically, that's release of information. But if you provide coding to other departments and they pay you back for it, that may be part of it. If you provide coding or transcription to like a physician's office and get paid for that, that may be part of your revenue. Um, Within hospitals, for instance, if you provide coding to an area and it gets, then typically the cost of that gets charged back to that area. It's not necessarily a revenue situation. Revenue is more outside of the organization or patient related. So budgets are made for a fiscal year. This is a consecutive 12-month period. It may be January to December, but most are not. Some start July 1st and end June 30th. Some start October 1st with the federal government and run through September 30th. And it is entirely up to your organization as to when its fiscal year is. They set that. Operational budgets are based on the money needed to run the business. So it is, um, it's pretty much everything that it costs to run the department. Okay. So, or the hospital in total. It includes labor, non-labor, supplies, all those types of things. You're looking at variances to see what was budgeted and then what were the actual expenses. As long as you're under, that's a great variance. If you're over, that's when you have to start drilling down and figuring out, well, how did we get over? Why did we get over? Was it an issue of what was budgeted? Was it something unexpected that occurred? Or is it just that some things were ordered and probably shouldn't have been, or maybe too much was ordered at one time? Those types of things. And you use it to monitor the activities of the department. So the variance formula here is amount spent minus amount budgeted. If that's a positive variance, that's not good. If it's a negative variance, it's good. I know that sounds counterintuitive, but think about it. If you're spending more than you budgeted, that's a bad thing. If you spend less than you budgeted, that's a good thing. Capital budgets. Capital budgets are different than operating budgets. Operating budgets, remember, that's the cost of doing business. Capital budgets are for major assets, like when you add on to a hospital, when you purchase a big piece of equipment, when you put in a new IT system. These are high dollar purchases. And your facility defines what high dollar means. Your facility may say it's anything over $500. Some facilities say it's anything over $200. So they define that. And travel education never falls into this. We're talking about things that depreciate. When you're talking capital budget, it's things that depreciate. So that could be equipment, like if you purchase a really expensive scanner or a really high-end copier or a new microfilm reader printer machine or movable files back in the day of paper records, or you get a new type of coding software or release of information software. Those are all capital budget things. And there's a different process to go through and get approval for capital budget items than there is for operating budget. They're two totally separate things. They may be done parallel at the same time. so that your capital budget because your capital budget and your operating budget will be on the same fiscal year, but they're very different things. So you would not put something in the capital budget and then put it in the operating budget. You would not do that. But what you would do is, all right, so let's go back and talk about, for instance, let's talk about that coding software. Let's say you put in to get this new high-end coding software and it goes into the capital budget. What goes into your operating budget would be the cost of training. It would be if you send someone away to a conference to learn to become a super user on your system. It would be the change in productivity, because when you implement a new software, when you're going through the training period and you implement a new software, your productivity drops because you're taking coders away from what they usually do. You're teaching them something new, and then when they first start using it, their productivity is not the same because it is new and they're getting used to it and all of that. If you're expecting that your productivity will be higher 6 months after you implemented your new software, then your FTEs, what you'll need for FTEs and all of that should reflect that. It should reflect that in that first 6 months of the implementation, you're using more staff hours and education hours, and your productivity is lower. And then the second 6 months, if that's how it falls in your fiscal year, you would have higher productivity, which means you need fewer FTEs. You wouldn't need the education dollars and some of those things. So that's where you would have it side by side. But the software itself would be in your capital budget. It would not be in your operating budget. And what it would take to implement on a human level usually will be in your operating budget, not in your capital budget. Because again, what it takes for the human piece doesn't depreciate. What it does with a piece of equipment or a major asset or a building or furnishings, those types of things, those are depreciating. So cost justification, is there a payback period? How long does it take to recover the costs? You know, will the benefits reach a point that you've paid off the cost? So it's the total cost of the project divided by annual incremental cash inflow. And then that annual incremental cash flow is the savings that a department realizes. And this just gives you cost justification, return on investment, the rate at which the cash is recovered from an investment project. And there's the formula for that. And let's see, your book will talk about that. I'm sure it does. Return on investment. I was looking for that. Well, it should be somewhere at the end of the chapter. It should be somewhere on page 163. I don't see it. I don't see return on investment in blue bold, which is what I would have expected, because return on investment is a very important aspect of budgeting. And it's something that if you want to pursue obtaining, you have to be able to demonstrate. So I'm kind of shocked that it's not here. But anyway, it's here on the slide. And as you read through page 163, be looking for that. All right, that is it for Chapter 9. I will be back in another lecture video to talk about Chapter 12. Chapter 12 is very long. There's lots in there about research and IRBs and things like that. So be looking for that second video, and that will be on Chapter 12. Hope you're doing well. Take care, and I will be back to talk to you soon. Bye.